The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Happy Monday, everybody. Live from Studio 2 at Bloomberg headquarters in New York, I'm Alex Steele.
And I'm Katie Greifeld in for Romaine Bostick. We're kicking you off to the closing bell here in the U.S.
You kicked us off to the opening bell and now the closing bell. It's like full circle for Katie. All right, let's get to the markets right now, guys. We got the S&P up by 0.1%, but we have 40% of the S&P reporting this week, a shockingly large number. So the action's really just getting started. And you can see sort of the individual asset classes and how they're set up. NYMEX crude down 1.6%. Really hard to find the why behind that, but energy stocks also getting hit. The 10-year yield on the back end getting a slight bid, although we are definitely off the highs of the session. We're getting the Treasury refunding announcement in just a moment's time, so we'll bring that to you when it does cross. And dollar yen just up by 0.1% because it's not just the Fed, it's also the BOJ. Katie.
Well, speaking of that, fasten your seatbelts because Citi says that the options market is pricing in an over 1% move for the Fed Wednesday. Implied volatility really spiking as traders prep for 32 hours of central bank decisions, topped off by jobs Friday. Meanwhile, the $9.5 trillion test with the Magnificent Four reporting this week with CapEx spend from Apple, Amazon, Meta, and Microsoft all in the spotlight. Now, the rotation trade taking a little bit of a breather today as tech outperforms. Meanwhile, the golden arches dull. McDonald's hit with its first sales dip since 2020, and the company warning that sales are negative in the beginning of the third quarter as well. The street takeaway, though, Alex, could have been worse.
It could have been worse, right? And we'll get to that later on in the show as well, and kind of what it means for other fast food plays. Let's just set up the week, the day, et cetera, what we're going to expect from the Fed in terms of cuts. This is the September pricing for a Fed cut. We're pricing in now almost a 25 basis point cut in September now for the market. And I guess the question becomes then, how does the Fed wind up signaling this on Wednesday? Is it going to be in the speech? Is it going to be in the communique? Is it going to be in the presser? How we're going to wind up getting that? And if we're going to do September anyway, why not just do it on Wednesday? Katie, that's really the question, right? What are we waiting for to really pull the trigger there from the Fed?
It's a great question. So let's get right to it with Alex Petrone. She is Director of Fixed Income and Managing Director over at Rockefeller Asset Management. Great to have you on set with us to kick off what is a huge week. I guess we should start with the Fed, of course. Someone actually described it to me as a back-to-school September rate cut. It feels like the entire market has just opened the idea of a September cut with pretty much open arms.
I think that's right, Katie. Thank you. Thank you for having me. I think it's really about that back to school cut. It's almost the school kit where everybody is widely anticipating and knows what's going to be in the kit. I think many are going to look to this week as a bit of a dovish hold from here. And they're looking to hear from Chair Powell. What are we doing next? What are we doing next? And it's unlikely that he indicates the timing, but I think it's clear that he's going to follow the narrative that the data is breaking in a direction in which September seems likely. It's fully priced in almost at this point into the market. Now, looking beyond that, the market's getting a little bit ahead of itself in terms of the magnitude of cuts that are priced in thus far this year, but certainly remains a lot to be seen, and we'll really be looking to the statement and the presser this week to get a bit more of an indication of where we go from here.
And what specifically will you be looking for, will bond investors broadly be looking for when we finally get to that statement, and then also when we actually hear from the man himself at 2:30?
Well, I think we all love hearing from the man himself, because that's the moment in which you expect that the narrative might shift a little bit differently than what we've heard thus far from Fed officials, and just, I think, a bit more of the certainty of the statement. And so at this point, if you look at what's priced in thus far this year, it's nearly 3 cuts between now and year end. So the market is really poised for this idea that the Fed message will be dovish, that it will be dovish. So if you get anything different from that, I think the market would be surprised by any type of hawkish messaging from here.
I just want to bring everyone some breaking news in terms of Treasury refunding and the borrowing announcement. So the U.S. actually cut its July-September borrowing estimate to about $240 billion from $847 billion. Then from October to December, it's looking to borrow about $565 billion. Now we're going to get where they're going to issue on the curve on Wednesday, but now we have the total amount. We're looking at that estimate coming down to $740 billion. billion from 847, which kind of pairs into what we're expecting in terms of the curve. Like, where is the massive amount of borrowing that we were expecting that's going to keep those high-end rates higher for longer?
Yeah, so number one, the market's going to like that refunding announcement is less. So that certainly gives some added fuel for rates to continue to come down a bit further. We saw a significant bull steepening last week. And then I think what the market's going to want to see is where on the curve. There's tremendous demand on the front end. Look at money market funds, $6 trillion in assets today. That's astonishing. And so what you've seen the Treasury able to do is really lean into that. It's those points in time where we've had fear and concern that refunding was going to be the longer end of the curve, that it's led to that bear steepening. So I think we're going to really be paying close attention to Wednesday and where on the curve you should expect.
So do we think that we're going to see that bull steepener continue, where you see the front end continue to bid and those front end rates come down? Or do you think the steepener where we see the long end sell off continue?
So it's really, again, it's dependent on so many factors to unpack. So let's unpack that. When we're talking about the direction of travel for the Fed, that lends to the front end coming down faster, right? And you continue to get that bull steepening impact. Other factors that we're thinking about, of course, is the refunding. And if you get to a moment in which people start to take a step back and look past the near-term expectations of the Fed, or some of the factors that we're thinking through with the election, and you look further out to deficits that are rising, then you have the potential for some pressure on the long end. But I think for now, expect some stabilization from here.
And it seems like when we're talking about the deficit, and we're having this conversation with, 99 days to go. I think it's 99 days until...
That is quite a countdown clock you're going to start.
I have it just, burned in my brain here. But it seems like no matter what happens, who takes control in November, that one of the things that you can bank on, forgive my phrasing there, is basically that the deficit is going to continue to grow from here.
That's right. That's right. I think we agree, regardless of the outcome of the election. And I mean, 99 days doesn't sound that long, but there's a long time and a lot that can happen in between. Deficits are going to impact markets on a go-forward basis, so you need some level of fiscal restraint. Whether we get it on a go-forward basis is a differing issue. Near-term, medium-term, long-term, I think of the deficits as having a meaningful material impact over the medium and the long term. In the near term, I would be more focused on slowing growth and where we head from here, cooling labor markets, where we head from here, and also a Fed that has been clear there is a path towards further easing. The gap between Fed funds rate, CPI, and PCE is quite wide versus the historic norms if you go back to the early 70s. So there's a lot of room here for additional easing. Do we get it this year? Absolutely not. But does it seem likely over the next 12 to 18 months that the key driver of rates is going to continue to be the Fed and their action? Yes, I think so.
Well, just quickly, I don't know about you, Alex, but when it comes to the deficit, the question that I always tend to ask is, can you invest around it? What is investable around it? Because we were having a conversation with Steve Eisman a few weeks ago, and he calls them the deficit people, that it's always this big issue, but when does it actually, and where does it actually show up in markets?
I think the deficit, can create some opportunities and volatility. We saw that in the third quarter of last year, in which all of the bond vigilantes demanded higher rates, and we said this is an opportunity to add for long-term investors to duration. That reversed in December. If you look at the market right now, we are looking at where are the best opportunities within fixed income. If you are a tax-paying investor today, then you want to be in the municipal market. Plain and simple. And if you really look around, you want to be in higher yielding municipals, plain and simple. Why? Well, yield is now going to be a key driver of returns on a go-forward basis. High yield muni indices, 545 tax exempt yield. That's 9% plus tax equivalent, well beyond what you can source in the corporate market. Meaningful spread, nearly 190 basis points versus investment grade muni risk. And then you layer on top pretty strong credit fundamentals and backdrop in the space. I think it's a really wonderful opportunity on a go-forward basis. And yes, rate volatility will matter, but it's looking into areas of the market that remain attractive in terms of all-in yields, tax equivalent yields, and then of course with resilient credit fundamentals from here.
I'm laughing. I spend so much time on radio talking to Paul Sweeney about how much he loves munis. So you're in good company, Alex. Thanks a lot. Alex Petrone, Director and Fixed Income, a Managing Director over at Rockefeller Asset Management. Thank you very much. All right, coming up, as earnings season roils on, you got Bloomberg Opinion's Conor Sen says the companies are actually signaling that they're only keeping headcount steady in anticipation of a September rate cut. So if we don't get that, then what happens?
Plus, CEO confidence, 3M getting an upgrade to buy over at Deutsche Bank. More on why the analyst is so impressed by the new chief executive in today's top calls.
And crypto stocks on the move after former President Trump turns from skeptic to Bitcoin cheerleader. All that and more coming up. This is The Close on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Do you think the jury's still out on the strength of the labor market?
Well, part of the problem is that July is usually a very bad month for jobless claims accuracy.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We see the jobless numbers climb just bit by bit by bit. Is this a welcome cooling or an unwelcome deterioration?
The July Jobs Report, Friday on Bloomberg.
We've heard from Powell that the dual mandates, stable prices, full employment, have come into better balance. And so they are going to be focusing on both of those mandates as opposed to just reinstating price stability.
That was Stifel chief economist Lindsay Piesga discussing the Fed's dual mandate. A Bloomberg Opinion columnist Conor Sen was out with a piece today that really delved into the employment side, saying that big business signals to Fed it's rate cuts or layoffs. So in the piece, he wrote, the clear message from this earnings season is that companies are only keeping headcount steady in anticipation of lower borrowing costs ahead. Conor Sen joins us now. Conor, great to see you. What do you mean? That the Fed doesn't cut? They're going to lay off a boatload of people?
Well, it's sort of a lot of them, especially companies tied to interest rates and housing, thought that we would get a recovery by the middle of 2024. People were looking for rate cuts this year. They thought home sales were unsustainably low. And what we've seen over the past couple of months is we can sustain this for a little while longer in terms of just a very low level of home sales. And so companies ranging from Whirlpool, appliance makers to boats to cars just haven't seen the recovery. And so analysts have asked them, what's going on? And these companies said, look, we thought we'd see the recovery this year. It hasn't happened, but the Fed's going to cut. And so we see brighter times ahead. And that message of optimism is what's holding the stock prices somewhat intact, which keeps pressure off of layoffs that otherwise would be coming.
I mean, when do you think that the rubber meets the road here, so to speak, in terms of how far rate cuts can be pushed back again? Because let's say that, I don't know, we get some crazy data points, September doesn't happen, but, the bond market again pushes back its expectations. I mean, how much further can this relief, so to speak, be delayed?
Well, I think for a lot of companies that are tied to the housing cycle, they're looking in terms of spring and summer is when they sort of expect to make their hay. So if things are weak in October, November, December, that's already a seasonally slow period of the year anyway. It's really, they need to see it by next spring, feel confident in next spring's housing season, next summer. And if that were to be shattered, then I think we would see layoffs just because these margins aren't great, revenue growth is not great, and they're holding staffing levels way too high for current activity levels.
Why are they holding on to staff?
They feel like it's been 2 years of a downturn, and they see the rate cuts coming. Brunswick, the maker of boats, actually called out September as when the Fed would start cutting rates. So it's almost like companies tied to housing and boats and cars are watching the Fed as closely as banks do. And it's really an unusual situation just because in prior rate cut cycles, it's usually been in response to recession when nobody's buying anything. But here it's much more tactical, inflation-based, and companies are kind of gearing up for it and trying to staff in advance of demand that they expect to come.
Okay, so it's less about the actual cut, but the idea that when the cut happens, demand's going to come kind of roaring back, and they want to be staffed for it. Does that also roar back wages? Does it roar back inflation?
So I think a lot of them are currently overstaffed for how much demand they have, and so they feel like demand could rise 10, 20% without increasing staffing levels. So that is something to watch after rate cuts, presuming we get them, is if the Fed's worried about a big hiring takeoff or wage growth takeoff, a lot of these companies feel very, very staffed already. And so I think it would take a lot to get hiring to really ramp up. But that's arguably what we need to see happen because the unemployment rate has been rising, the hiring rate has been low, and we probably need to see a pickup in hiring to stabilize the unemployment rate.
I'm wondering, what if we do get a rate cut and it turns into this sort of start and stop rate cutting cycle? What if we only get one? Does the magnitude matter here, Conor?
Yeah, I think it's sort of companies are saying we don't know how many cuts we're going to get, but we expect that however many cuts we get will boost our demand. And so we're all kind of guessing about how much will the housing market respond, how much will the auto market respond. We're not really going to know until the cuts start. We'll see if mortgage rates do come down as much as some people are hoping for and expecting. And I think it'll probably shake out in the first half of next year in terms of will we get the boost that companies have staffed up for and are expecting? And if we don't, then either the Fed has to do more, or maybe companies will start laying off people if they feel like they didn't get the demand boost they expected.
That's a good question, though, because if we go more the way of the ECB, which is like one cut, hold for a bit, one cut, hold for a bit, that's a whole different kind of world. In the meantime, what are we looking at in terms of margins? Like, when is that going to get margin relief?
And I think we're going to need to see a pretty meaningful pickup in demand to get that margin relief. I mean, the fortunate thing is that because they feel like they don't have to staff up a whole lot, any kind of demand increase and revenue increase could flow through to the bottom line, which is maybe one of the reasons why a lot of these stocks aren't doing worse. But it's sort of an interesting cat and mouse game of demand is weak. The Fed is sort of trying to figure out what it wants to do, and investors are trying to game out how much will demand grow after some number of cuts we don't know when we're going to get or how many we're going to get. But you don't want to be the one who sold at the bottom before the rate cut started.
And Conor, I mean, just to wrap it all together, so the title of your piece is Big Business Signals to the Fed that it's rate cuts or layoffs. Do you think that the FOMC members are hearing that message? Do you think that they're also pouring through the earnings calls like you are and have also picked up on this?
No, they're reading Conor.
That's true.
Obviously, right?
Yeah, Bill Dudley and me, right?
Yeah.
I think that they are. We do know that a lot of the Fed members are more focused on talking to businesses on the ground. We've heard them in recent weeks talk about the labor market being more back in balance. Powell's talked about the labor market being back to 2019 levels. So I suspect they're onto it. But I think Wednesday will be the test of that of, is the Fed willing to acknowledge what people on the ground are saying in terms of things are in balance, inflation has slowed, it's time to cut. And if not, then companies have a lot of hard choices to make.
Conor, always great to speak with you. Really appreciate your time. Our thanks to Bloomberg Opinion columnist Conor Sen. It's also a good reminder that it's not just the Fed on Wednesday. We do get an update from the labor market on Friday as well. It's just a busy week, Alex.
It is a busy week. So I heard that, back in the day you were house hunting, right? And you said no.
Yeah.
So if rates get cut and supply comes back a little bit, like, is Katie Garfield pulling the trigger here or no?
Well, I mean, to extrapolate it out, it's a good question. How much pent-up demand is there on the sidelines? From me, I just signed a 2-year lease, so I'm probably out of it for a while. But, I mean, the housing market's going to be fascinating when you do finally get that drop in rates. But
yeah, and we want to see prices come down because all of a sudden supply comes on. Is that then a buyer's market, or are rates just too high that it just makes it even more difficult? I don't know. You let me know.
I will. I will keep you updated there. But let's take a hard turn next, because coming up, we're watching crypto stocks flip-flopping after former President Trump's keynote speech at the Bitcoin conference over the weekend. We're going to break down some of the moves. This is The Close on Bloomberg.
The Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
This afternoon, I'm laying out my plan to ensure that the United States will be the crypto capital of the planet and the Bitcoin superpower of the world, and we'll get it done.
And that, of course, was former President Donald Trump speaking over the weekend about his plans for crypto if he is to be reelected. And crypto stocks in the wake have been on the move since those comments. Abigail Doolittle has been tracking the crypto stocks. And at least when it comes to Bitcoin itself, I mean, we saw a little bit of a reversal today. What are we seeing in the equities?
We're seeing a reversal there as well. So Bitcoin earlier today at session highs up about 3% on the day, now down about 1% off the lows. But nonetheless, it feels like a little bit of a sell the news moment, because relative to the stocks, MicroStrategy, Coinbase, and some of these other stocks also lower. And, sell the news makes sense, because this space up in a huge way on the year. MicroStrategy, I'm taking a look at here, up 167% on the year, even with today's decline. Bitcoin itself, off of the April lows, up about 40%, the July 5th low, up about 40%. So I think some of this was priced in, this positive shift from Donald Trump, not entirely new. It's new from his former position, but in terms of the idea that his campaign, the MAGA agenda, is going to turn pro-crypto, that itself is not entirely new. It's just some of the details that came out over the weekend that are a little bit more fiery, I would say.
So here's two things I don't get, and actually Katie can answer this too because she does the crypto show. But one, why are we believing President Trump on what he says anyway? Because we know that things get reversed, and I can imagine on an agenda, crypto is definitely not first on things he's going to do if he goes back in the White House. And two, my other one is, are we just looking for a catalyst? Like, there is no catalyst in the crypto market right now. We went through the halving, and this is where we're at. That's now been wrung out.
ETF,
we got the big exactly right. So now we're just looking for something else.
I think yes, to some degree, we are looking for something else relative to what Donald Trump may or may not do if he is elected into the White House. Relative to his agenda, I can't answer that, but he has come out with a really strong stance in terms of saying he's going to go after Gary Gensler. He's going to put somebody pro-crypto into the SEC. He's going to create a crypto advisory council. We're going to have a stockpile of crypto. We're going to be the world's, I think he used the word the planet, the U.S. crypto capital of the planet. So again, very strong language there. In terms of looking for something, yes, because there's not a lot fundamentally that drives Bitcoin or crypto. I mean, for some of the crypto stocks, it could be their earnings reports. For Bitcoin itself, right now, it's hitting up against resistance at 70,000. It's had a very hard time over the last several years making it above that level. So we're going to need something new, something really surprising. Otherwise, I would argue we're going to go back down into the range. And frankly, the longer term technicals look like we are going to go back down toward 40. Could we pop higher in the near term on some froth? Absolutely. But Bitcoin is very good over the long term of going higher, but consolidating in big gaps down as it does so.
So, I mean, this is what, of course, we just heard from Donald Trump speaking at this conference. What do we know about, the Democratic stance on crypto?
Well, I heard just recently that Kamala Harris is maybe becoming a little bit more positive. It seems as
two
though
ETFs got through. Like, it's not like he banned it. But anyway, sorry. Go ahead.
Yes. Yes, that's exactly right. But I think that she is actually going to become a little bit more outwardly positive from what I've been reading, so that's not going to be something that the crypto people out there could hold against her and do toward Donald Trump. He apparently has a lot of money coming to him from some of the crypto folks, like the Winklevoss twins, along with, I guess there's even some PACs that are being funded by crypto. So I don't know if she's getting into it on that degree, but I think that she's trying to provide the sense that her potential administration would be somewhat crypto friendly as well.
Well, a lot of these crypto people, there's like single issue voters, especially if you take a look at social media and the way that they vote. So it makes sense that they would be donating to
That makes sense to me also, because I think of crypto folks as the gold bugs, very emotional, and so it makes sense that it could be binary.
Gold bugs are very emotional. All right, Abigail, thanks a lot. Really appreciate it. Abigail Doolittle joining us there. All right, coming up, how a near collision in one of Tesla's autonomous cars left an analyst at Truist befuddled in its future. Really fascinating conversation. Plus, the same day, you have Morgan Stanley actually upgrading Tesla to their top pick. We're going to break all that down for you ahead of tech earnings. This is The Close on Bloomberg. It is just about 3:30 in New York. This is the Countdown to the Close. I'm Alex Steele.
And I'm Katie Greifeld, in for Romaine Bostic.
All right, let's get to some shares of Tesla here. We're watching them after a Truist Securities analyst with a hold rating on Tesla says the EV maker is not even close to solving autonomy. William Stein recalled his wild ride in one of Tesla's self-driving cars, saying it accelerated through an intersection as the car in front of us had only partly completed a right turn. My quick intervention was absolutely required to avoid an otherwise certain accident. Tesla didn't immediately respond to request for a comment. That stock is up really because Adam Jonas over Morgan Stanley upgraded to top pick. Bloomberg Technology co-host Ed Ludlow is joining us on set. It's a sexy note from a sell-side analyst. What'd you make of it?
Well, there are some really important things to clarify. The first is that he was using version 12.3.6 of FSD Supervised, which at this point is now obsolete. 12.5 came out starting Friday night, and in a limited release has gone to others. I got it Friday. I used 12.5 Saturday. I recorded my experience on the social media website X. You can see what I said. It's an improvement. But the main point to clarify is that what William Stein at Truist is doing is he's taking a specific comment Elon Musk made on the first quarter and second quarter earnings calls, which is investors should judge Tesla's ability to solve for autonomy, active tense, by going out and experiencing themselves. And so what he's saying in his note is, my experience, based on this now obsolete version of the software, is it's not ready to solve autonomy. It hasn't done. But by extension, he just doesn't see the jump. Because if we do eventually have this robo-taxi event, right, October 10th, it's how do we get from this consumer car with software that has experiences like these to a future where Tesla vehicles drive us around in the back seat, right, with no driver in the front. And he just doesn't see that jump. And he's coming on my show tomorrow, and I'll ask him the tough questions that a lot of our audience have asked me to ask him.
Yeah, definitely looking forward to that conversation there. Of course, Tesla shares currently up about 5% today, so not exactly denting the stock. Let's talk about the broader week, though. The week that you're in New York is a big week for tech earnings and a lot of focus on AI. It seems like the names that have already reported, there's been a lot of skepticism, a lot of show me the money when it comes to your ROI on AI spend. I mean, what are you looking for?
So you have to find some commonality between those 5 mega cap names, 5 being Alphabet last week, and then this week Meta, Amazon, Apple, and Microsoft. And I think across all the notes and previews, it's tell us explicitly and clearly in a way we understand, for every dollar you've invested into AI, how many dollars are coming out. And Alphabet had a stab at it. You know, they said year to date, we've made billions of dollars on generative AI and AI infrastructure with our cloud business, but that just wasn't enough for many. You know, they want something a bit more sort of layman's terms for the formula on that.
All right.
Show me the money.
Show me the money.
Literally, show me the money.
Really, that's what earnings season is all about. Ed, great to see you. You're going to be a busy man this week. Stay close. That, of course, is Bloomberg's Ed Ludlow. Now, in addition to tech earnings this week, investors will also get a kick out of tonight's fireside chat on AI between NVIDIA CEO Jensen Huang and Meta CEO Mark Zuckerberg. And joining us now with more, we have Olivier Blanchard. He is research director of the Futurum Group. And it's interesting, of course, NVIDIA makes the chips. Meta makes products that use the chips. What do you think that this conversation will sound like?
Well, that's exactly right. And I think it echoes lightning. It echoes some of what Ed was just talking about show me the money. I think it's really important at this juncture for NVIDIA and for Meta to start telling a more, I guess, complete story about the trajectory of both of their companies and the intersection of AI and how AI can enable a lot of the use cases, a lot of the user experiences and products and revenue streams that Meta is going to be working on and investing in for the next 10 years. And it's likewise also important for NVIDIA to show a broader story about how it's not just about the chips. Ultimately, it's about the types of experiences and capabilities that NVIDIA and other chip makers like NVIDIA can bring into the ecosystem, and how AI can enable a lot of other use cases that aren't necessarily, what we think of as, AI, but that are definitely AI enabled.
Well, that makes it so interesting in terms of Meta, because with the likes of Google and Microsoft, they at least have cloud offerings that they can incorporate with AI. So there is some kind of revenue stream, even if it's quote unquote small. I don't know what Meta has to show for that.
Right. Well, so far, not quite a lot. Okay, on the one hand, obviously you have Meta and its Llama 3.1 or just Llama large language model to begin with, which is open source, and that obviously Mark Zuckerberg talked about at length last week, and sort of introduced as a big open source version of large language models to compete against some of the more private ones. So that's one aspect of it. Another one is, let's not forget that Meta also essentially owns the XR business, or the XR space. So you have virtual reality, you have mixed reality, you have augmented reality, and you also have smart glasses. And a lot of that is going to be enabled, on the one hand, by voice commands and interactions that are basically AI assistants, allowing you to go hands-free with a lot of these devices, which I think is going to make them much more accessible to a lot of consumers and a lot of other users. But also there's the creation, the content creation, the entertainment, the gaming, the entire sort of virtual ecosystems that are going to need to be built, and AI gets to play a part in that. So there's that revenue piece of the equation that essentially sort of resets Mark Zuckerberg's vision for the metaverse, which I think was lacking and not particularly mature 2 years ago when it sort of flopped. But I think that 5-6 years from now, we'll be able to get back to that. And I think the next few years are going to show how much AI is going to help build that. And the third piece is, I think, just the role that AI plays in entertainment and UX for users of Facebook, users of Instagram, and other platforms that Meta is investing in.
Well, you brought up timelines a little bit, and that's what I want to get to, because when it comes especially to some of Meta's products, like you mentioned, the glasses, for example, even if you put AI on it, I mean, how long is it going to take for that to actually penetrate into the broader public where people regularly use these things?
Well, I think we're already starting to see that. Last year, one of the standout products I thought, it didn't make a huge splash, but I think it was sort of a harbinger of what is to come, was the smart glasses that Meta put out with Ray-Ban, and those are powered by the Qualcomm Snapdragon platform, which is also sort of enabling a lot of these new use cases in XR platforms. But essentially the ability to tell your device to do things and to talk to it, much in the way that right now talking to devices, whether it's your phone or your smart speaker or increasingly your PC, is going to be a regular part of how we do things, how we tell our device to do some things for us, and essentially enable agents and assistants that are voice activated. All of that is going to penetrate the XR space as well. And one of the issues with XR is it seems cool, and we've seen sci-fi movies, right, where it's fun to have VR and XR and augmented reality, but it's difficult to actually create value for everyday users because you still need a keyboard, or you need to be able to talk to it and it needs to be able to understand you. And I think that having much more advanced AI capabilities on the device, not just through connectivity, but actually living on the device, is going to enable this. And so if you can talk to your device and ask it to do things, you don't need to be holding your phone or looking at a screen or tapping on it. You can talk directly to your eyeglasses and they can interface with you. And it's a much more natural interface. And so I think that's where we're going to see that space kind of accelerate a little bit in the next 3-4 years.
Right, but what happens when I put my glasses down and I can't find them? How can my glasses help me find my glasses? You see what I'm saying? Because that happens to me a lot. All right, Olivier, thanks a lot.
Well, yeah. You can just tell them, hey, where are you? And they'll answer. So that's good.
That doesn't at all sound weird. All right, Olivier, thanks a lot. Olivier Blanchard, research director over at the Futurum Group. Really appreciate that. All right, coming up, 3M's newest CEO is impressing analysts over at Deutsche Bank. We're going to talk about that next in Top Calls. We'll get the details of his long-term strategy. This is The Close on Bloomberg. Time now for some more top calls. A look at some of the big movers on the back of analyst recommendations. And today we wanted to highlight 3M, the conglomerate that makes everything from tape to facial masks to stuffed airplanes. Deutsche Bank lifting its rating to buy from hold. The analyst says she was impressed with CEO Bill Brown, who started his tenure in mid-March. She went on to call his focus strategy well thought out. Now, yes, shares are down 1.5% today, but they were up by a record amount on Friday. So, it needed a little bit of time. Joining us now with more is the analyst behind that call, Nicole Deblase, managing director over at Deutsche Bank. Nicole, it's been a while since we've had an industrial conglomerate actually start to really shine. Was this surprising to you?
Yeah, I think we had kind of high expectations going into Friday because we had heard really good things about Bill Brown from his tenure at L3 Harris, but kind of wanted to wait to hear his message from himself and hear about his key priorities before making a decision about what to do with the stock.
And it's interesting to read through, of course, your reaction, your analysis, and also what the rest of the street is saying, because you have J.P. Morgan highlighting his conservatism. You also have RBC saying that perhaps he's setting up a strategy of under-promising and over-delivering when it comes to managing expectations. Did you get that sense as well?
Yeah, completely agree. Starting with just the guidance for this year, right? They beat earnings by 18%, beat consensus by 18% in 2Q, and only raised the full year by 2%. And yet, they've been executing really well. Top line was a bit better than expected. We see opportunity for margins to continue improving from the first half into the second half. Mm-hmm. So we would argue that even the guidance for 2024 looks very conservative.
Yeah, that was what, in general, it was like, too conservative, so there is that upside. So by their own admission, they're saying that core businesses are kind of suffering, but really moving to focus on automotive electrification, climate tech, as well as industrial automation. When do you think we start to get the results from some of those sectors, and what do the results look like?
Sure. I think we're more excited about the cost opportunity here with Bill Brown as CEO. I think from an organic growth perspective, 3M is an extremely diverse company. Even Bill Brown will admit that, this is more of a GDP grower. So we think that they could potentially reinvigorate organic growth to maybe the 2 to 3% range relative to like a 1% average over the last decade.
Mm-hmm. And again, just reflecting on how much 3M actually jumped on Friday, 23%. That's the biggest one-day gain since what? I don't know, the 1980s? Ever. So when you think about the rest of the industrial companies that you cover, do you think it's possible that some of the boards at the other companies are taking a look at what happened at 3M and saying, maybe we should shake up the C-suite, or am I getting too ahead of myself?
I mean, I think we are running out of traditional conglomerates in this space, to be quite honest. I mean, you've seen so many companies. Let's think about, GE. There are so many examples of companies that have gone from being huge conglomerates to closer to pure plays. And for a lot of these companies, that strategy has really worked. 3M, it's spun off its healthcare business earlier this year, right? So I think becoming more focused is something that investors really want to see right now. And I think that's, definitely something that other conglomerates should be thinking about.
All right, Nicole, thanks a lot. We got to leave it there. Really appreciate it. Nicole Deblase joining us over at Deutsche Bank. And of course, Honeywell really coming front and center on that. It's a huge conglomerate and has really stood by its conglomerate stance despite pressures from investors and shareholders to maybe spin some stuff off. Honeywell looking at that. All right, well, coming up, we're going to continue to count you down to the closing bells. Nancy Tengler is CEO and CIO over at Laffer Tengler Investments. We'll be breaking things down as we go. If I just take a look at where markets are, the S&P just up 0.3%. Volume very light as we head for a very busy week. This is the close on Bloomberg.
Many are going to look to this week as a bit of a dovish hold from here. And they're looking to hear from Chair Powell. What are we doing next? What are we doing next? And it's unlikely that he indicates the timing, but I think it's clear that he's going to follow the narrative that the data is breaking in a direction in which September seems likely. So the market is really poised for this idea that the Fed message will be dovish, that it will be dovish. So if you get anything different from that, I think the market would be surprised by any type of hawkish messaging from here.
That was Alex Petrone, Director of Fixed Income over at Rockefeller Asset Management, helping us kick off the show. Kate, let's get a check in here on where markets are, because I got to say, it's a nothing burger today, but that rotation that we've seen into small caps out of tech, that is taking a pause today. You're seeing energy, the worst performing sector on the S&P, but we are off the lows of the session, and the Russell's down 0.8%, but it has such a monster run that kind of taking a break right now seems to make sense.
Yeah, absolutely. And when we talk about that rotation, it's not just size. It's not just large to small. It's also sector to sector. It's an interesting note out from Goldman today saying that basically hedge funds unwinding their bets in industrials, instead going into energy and materials. So there's a lot of action under the hood right now.
That's such a good point. Let's get more analysis there with Nancy Tengler, CEO and CIO of Laffer Tengler Investments. Hey, Nancy, do you buy the rotation, small caps away from tech, or is it within the S&P in different sectors?
I think the small cap trade is a trade, the rotation into small cap. If you go back and look historically, Alex, as we've done over the last 20 years, the small caps have underperformed by 250 percentage points. If you go back to 2000, they've still underperformed, though a lot less. So I think you need really aggressive rate cuts from the Fed, which I don't think we will get, to sustain that trade into more of an investment. So I think you want to rotate within the S&P, which is what we've been doing.
So rotate to where? We were just talking about how Goldman says they're looking at hedge funds, selling industrials and buying things like energy and commodities. What do you think?
Yeah, so we were already there, and we took some nice profits in commodities a while back. And so what we've been doing is really following our theme, which I've talked about on your show a ton, which is old economy companies that are embracing the digitization of the economy, as well as cloud computing and generative AI cloud computing. And so we like a number of specific stocks within sectors, as well as the suppliers of the picks and shovels. So we just recently added to Emerson. We've owned it for a while. We added to our position in Quanta Services. We added to our position in Prologis. And these represent the old economy companies that are in the sweet spot of the movement to generative AI. And then we own a lot of the usual suspects. ServiceNow is one of our biggest holdings in our 12 best ideas portfolio.
You know, I have to say that's the second time in a week someone has brought up Emerson. And of course, the performance over the past year has been very impressive. But Nancy, I want to go back to that theme you have, which is old economy names that are embracing AI. I know that's your sweet spot. It's been interesting so far in earnings season, sort of this show me the money kind of impulse that we want to see return on investment for what you're spending in AI. And so when you look to some of those names that you like to, I mean, how patient do you have to be?
Well, you know, I've drawn an analogy for almost 2 years now to the 1990s when I was actually managing money. And this is so much different than that, but analogous in so many ways. And what I mean by different is this is a much more robust collection of technologies that we're contending with right now. And I think we're in early innings of really seeing the use cases and benefits for generative AI. So if Google has to spend $48 billion in CapEx and they still generate $70 billion in free cash flow, I'm okay with that as long as eventually they do monetize it. And we saw some green shoots in that regard during the last earnings report. So I think this is an opportunity to add to Google. We'll see what Microsoft has to say tomorrow. But I think if you just look at the large cap technology names, they've got the best balance sheets, they've got the best free cash flow, and they've got the best earnings. And that's for the foreseeable future. So I would continue to use weakness as we did in the summer of 22 when we were told the tech trade was over, summer of 23, right before ChatGPT. And again, this summer, we had been selling in July. We're going to be adding back in the coming weeks and months.
So conviction there when it comes to tech. I'm actually still stuck on what you said about small caps being a trade, not an investment. What would turn it into an investment? Do you need to see those aggressive rate cuts? Or if you saw something truly impressive on the earnings front, would that be enough?
Yes, I think from a fundamental standpoint, I think that's what we would like to see because the earnings expectations are moribund. If you look at the floating rate debt in many of these companies, it's super high. So you do need to see not just one rate cut in September or two by December. You need to see a series of rapid rate cuts, I think, for these stocks. The fundamentals to improve. But that doesn't always influence Wall Street. There's a lot of trades going on with the algorithms and the hedge funds. And so you see these moves and in and out. I wrote a piece about how not owning NVIDIA, there was a quote in the Wall Street Journal, it was like having a root canal without a Novocaine.
Oh,
I actually had a root canal without a Novocaine. It's not even close, but that marked the top in the stock, and it has sold off pretty seriously since then. So you don't want to chase these things. You want to let volatility be your friend and buy when things are weak.
Why? Why would you have a root canal without Novocaine?
I was bad dentist. I was a kid, and my parents were going on vacation. Yeah, it was crazy. You just ultimately you just pass out.
Oh my God. Okay, so basically it's worse than that. So if you don't own NVIDIA, then you're passing out for a long period of time. That sounds terrible, Nancy. Going to the small cap thing, it's interesting though, because Lori Calvasine of RBC in her note today was talking about the fact that usually for small caps to truly outperform and maintain that, you need to have a recession. If that's the case, and we do head into more turbulent economic times, what works in that environment?
Yeah, defensive names, and she's right about that. And that's why if you go back and look at the small caps back to before the market corrected in 2000, you see a much different cumulative return than you do over the last 20 years, for example. But you would want to own dividend names, which we do own, dividend growers, and then defensive names to kind of keep you, because the Fed will then cut rates. So REITs, electric utilities, consumer staples begin to look attractive again. And we got a brief little bit of that rally in the fall, as we did with small caps. But I just don't see the Fed cutting that quickly or that rapidly, and I don't see recession. So I think you want to stay in the reliable earnings growers, and that's, these names that I've mentioned, as well as the old economy companies I mentioned as well.
All right, Nancy, we appreciate you. We would not give you a root canal without Novocaine. Nancy Tengler, CEO and CIO of Laffer Tengler Investments. Thank you very much. And to add on top of that, you get 40% of earnings from the S&P this week, and you have about $15.3 trillion in market cap for the whole week reporting.
An embarrassment of riches, too. You think about the Fed picture, you think about the economic data. I can hardly keep it all straight.
Yeah, it's going to be quite a week. Well, obviously, we're looking for that within the options market. Citi was looking at about 110 basis point move for the S&P. All right, we are moving closer to the closing bell. Full market coverage right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day on this Monday of a very busy week. Alex Steele and Katie Greifeld, we are here to help you take you through the closing bell. In a global simulcast, we are joined by Tim Stenovic and Emily Griffeo, bringing together on Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. But guys, Tim, it's a little boring right now.
Yeah, it's okay to say that. I agree. But I think it's boring for a reason, because we have a huge week. I mean, the Fed kicking off its two-day policy meeting tomorrow. We got July employment figures coming on Friday. We got a huge number of earnings this week, including from 4 of the Mag 7. So, investors taking a step back today and saying, okay, we'll wait to see what Jay Powell says on Wednesday.
And they're really taking a step back from the Russell 2000, that rotation trade that we talked about, investors moving out of mega cap tech stocks into these smaller names. It wasn't playing today with the Russell down over 1%.
Yeah, it's really interesting. We were just talking to Nancy Tengler, who said that basically this rotation into small caps, it's a trade. It's not an investment. You'd need to see either an aggressive rate cutting cycle or fantastic earnings. We'll see, of course, if any of that materializes, but it's true. Today, at least, the rotation trade taking a pause.
What is really interesting, guys, is that I keep getting notes talking about certain funds, systemic funds, like volatility of funds, like CTAs, that they're going to have to keep selling, particularly if volatility winds up picking up. And you have to wonder where that selling was today. All right, we are just moments away from that closing bell. There it is. Nothing to see here, guys. Maybe tomorrow will be a little bit more exciting when we get Microsoft. Volume also very, very light. The S&P, we're settling out here, but the S&P looks to be pretty flat, just up by about 4 points. The Dow Jones Industrial Average up by about 0.1%. The NASDAQ also pretty much flat, just up by about 12 points. Volume quite sad, Tim.
Okay, maybe folks are on vacation. Maybe they're just waiting for what happens later this week. The S&P 500, 277 stocks moved higher. Katie, let's go ahead, actually, 276 as they get settled. 223 did decline.
All right, take a look at the sector level right now. You had more green than red, of course. 7 sectors in the green, led by consumer discretionary, up about 1.4%. It certainly helps that you had Tesla up about 5.6%. Also a nice reminder that Tesla is a consumer discretionary stock. Now, you go to the other side, though, what didn't too hot today. Energy leading the way to the bottom. Energy down about 0.9%, followed quickly by tech there, off by about 0.3%.
Okay, I'm going to talk about some of the stocks that did move higher. You mentioned the consumer discretionary stock Tesla. Shares did finish the day higher by more than 5%. The reason they rallied today is because Morgan Stanley came out and named the company as its new top pick within the U.S. auto sector. It replaced Ford. Adam Jonas over at Morgan Stanley maintains his overweight rating. He's got a street high $310 price target on Tesla. Ford also is still overweight among Morgan Stanley's coverage. Cost cuts and restructuring have helped to restrict the downside of Tesla's EV business, according to Adam Jonas over at Morgan Stanley. Tesla shares higher by 5.6% today. On semi shares, rising double digits today. It's the biggest intraday advance going all the way to November of 2022, up more than 11.5%. The company did report second quarter adjusted earnings per share that came in ahead of estimates. KeyBank Capital Markets said the results were strong, but third-party guidance was mixed. Investors shrugging off that mixed element, setting shares higher by 11.5%. And McDonald's out early before the bell this morning with its latest report, and investors shrugging off the company's first sales drop in 4 years. Executives at McDonald's pledged to launch new promotions to help stem a decline in customer visits. Comp store sales fell 1% from a year prior in the second quarter. It came short of analyst expectations. Each of McDonald's geographic segments also saw sales declines, though the decline in same-store sales seems to have been less pronounced than some in Wall Street some on Wall Street expected. Shares finished the day higher by 3.7%, but they did rise more than 4%. In intraday trading.
Are we not into McDonald's, Tim? Is this not a thing for you?
I haven't been to McDonald's in many, many years, but apparently the $5 value menu is back. Yeah, and the average check with that comes in at $10, so it's doing its job of getting people in and spending more money. But it remains to be seen what they do, how they add to the value menu to keep bringing folks in.
Yeah,
I just don't know how they do it for so little money.
I think isn't this like the classic company thing? Like, do you have volume versus margin? And if you get enough people in the door, then basically that will wind up helping your margins at the end of the day because the revenue, the top line.
Yeah, you just hope that they just keep buying soda, more and more soda, because the margins on soda are so good.
Okay, Tim is talking soda and burgers. I'm talking beers because Heineken ADRs were dropping over 10% today, the worst drop since March 2020, after the company said it took a one-time impairment of roughly $949 million for the decline in valuation of its stake in China's largest brewer. The Dutch brewer cited a fall in the valuation of its stake in China Resources Beer Holdings Company due to concerns about consumer demand in the mainland that have affected its share price. The brewer also said that consumer spending is under pressure in both the U.S. and Europe. I'm also looking at shares of Charles Schwab, that stock down about 2% after the financial firm was downgraded to neutral from overweight at Piper Sandler. Analyst Patrick Moley said the tenets of his bullish argument haven't materialized and that he expects uncertainty around the firm's strategic shift to weigh on shares. And this is coming after Charles Schwab said earlier this month it plans to reduce the size of its bank and rely more on partnerships. And lastly, Integra Life Sciences, that stock plunging about 22% after the medtech company cut its revenue and profit forecast for the full year, finishing down about 19%. So a little bit of a recovery, but not much. The firm also gave guidance for the third quarter that fell short of estimates.
All right, guys, let's get to the bond market here. So it was an interesting day, but we did get interesting stuff coming at 3. So all across the curve, you saw a touch of buying, maybe on the back end, yields down by about 3 basis points. The front end really couldn't make up its mind of where it was going to go. But the question about a steepener coming into play continues as we head into that Fed meeting in Jobs Friday. At the top of the 3 o'clock hour, we heard the U.S. Treasury reduced its estimate for federal borrowing for the current quarter and projected the government's cash buffer to decline toward year end, just ahead of a possible fresh fight over the debt limit. Yay, we love the debt limit fight. But the Treasury Department said in a statement that it now estimates about $740 billion in net borrowing for July through September. So that might take a little bit of pressure off maybe the long end that some might have been expecting, Tim.
Okay, well, you're talking at Treasuries, I'm talking Tesla, because there was an article out today from Craig Trudell that talked about an analyst. You guys know full self-driving. Tesla full self-driving, right?
FSD.
I mean,
FSD.
In theory, like it does it for you?
Yeah, theory is a good word to use because it's not actually fully autonomous, despite the name full self-driving. So an analyst over at Truist, William Stein, he test drove a Tesla vehicle, used full self-driving, and narrowly avoided a crash, Emily.
He said that the Model Y that he was driving accelerated through an intersection as the car in front of him had only partly completed a right turn. And then he said that his quick intervention was absolutely required to avoid an otherwise certain accident. So in other words, if he hadn't intervened, the car would have crashed. You still needed that human touch in this full self-driving car.
Well, you guys, we kicked off at 3 p.m. One of the first things we did was talk to Ed Ludlow about this. And an important clarification, apparently he was driving the 12.3.6 version of FSD.
Okay.
Alex, feel free to come in here. Apparently that was the, they've updated it since. So he put out this note and then they rolled out the next update, I think today. So I don't know. Maybe that problem has been fixed in this most recent update, but I think the broader point remains that when it comes to solving that problem of full autonomy, full self-driving, that maybe we're still a ways off.
This is great. I really like this discussion. But really, do we care about anything but the Olympics? Because I was totally glued to my Peacock on Apple TV
I leave in a week.
All weekend. What's that?
I leave in a week. I'm going to the Olympics.
You're going to the Olympics?
Yeah, I'm competing. Just kidding.
No, wait, I really believe that for a second.
Same with the McDonald's.
Can you imagine?
But I am flying out to the Olympics. I'm so excited. The opening ceremony's super interesting.
Super weird. Let's call it as it is.
Super weird. I did like the horse galloping on the water. That was kind of inspirational.
Was it though?
I thought it
was it scary?
No, I thought I was revved up. I wanted to get out there.
Alex, how is I heard the Peacock experience has been great. They give you an option of like what to watch live, and it's kind of interactive.
So they do, and that's cool. And you can also like choose from many things, and there's like 4 different screens that you can be looking at, and that's great. But I like the commentary. I like the NBC packages. I like to feel things when I watch the Olympics, and they don't have that across all the boards, and that was very distressing to me.
I admit I'm planning on just watching the Simone Biles gymnastics routines on YouTube because all of these streaming options are very complicated.
Sadly, I've missed everything, and a lot of this competing happens while we're at work. So
you can do both.
Yeah, you can't do both.
You don't have
I need
the
to really
TV
on your computer.
Can't do both. Hard to do both. Alex, I'll swing by your desk and we can watch some Olympics. That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We'll see you guys tomorrow, same time, same place.
All right, coming up, we're going to preview the big week ahead for central banks. It's not just the Fed. Jennifer Lee, senior economist over at BMO Capital Markets, joins us. This is The Close on Bloomberg. All right, welcome back to The Close on Bloomberg. I'm Alex Steele.
And I'm Katie Greifel. Let's take a look at where markets closed out the day, the first trading day of what's going to be a very long, very busy week. It was pretty quiet if you take a look at the broader equity markets. The S&P 500 finishing 0.1% higher, if that. The NASDAQ 100, of course, big tech leading the charge here, up about 0.2%. Small caps taking a bit of a bath today. The Russell 2000 off by about 1%, a pause on that rotation. You did see a bit of a rally when it comes to the long end of the yield curve. 10-year yields falling about 3 basis points, Alex.
All right, we did get some big movers here that we did want to highlight. One of them is on Semi. That stock is up almost 12%. We haven't seen this kind of move since 2022 for the company. Second quarter adjusted earnings per share came in ahead of estimates. They also had solid earnings as well as gross margins. Plus, you get some upside, they say, coming from the industrial end market. That's always a positive sign. And Tesla up by about 5%. Adam Jonas over at Morgan Stanley named the company its new top pick in the auto sector. It replaced Ford, basically saying that Tesla may be cornering the market on zero-emission vehicle credits, also accrediting the company with some cost cuts and restructuring that has helped now restrict Tesla's downside. Those are some of our top 2 stocks. Now, our top story for the hour is McDonald's. You're sort of loving it. The company reports its first sales dip in 4 years, showing just how stretched people's budgets actually are. The company is saying it will raise prices less this year as the backdrop is more difficult than they expected. You got low-income diners are hurting. Now, the stock ending the day higher, though, putting the pressure on other fast food chains. You got Wendy's and Starbucks also reporting this week. Katie?
And joining us for more, I'm pleased to say we have Daniela Sirtori joining us now. Let's start with McDonald's because the stock initially fell pre-market. Then, of course, markets opened. It ended up finishing almost 4% higher. It feels like a lot of hopes and dreams are being pinned on this $5 value deal.
That's a really good way to put it. It was surprising because the results were not encouraging. You know, same-store sales declined for the first time since 2020, but it seems like that was less pronounced than perhaps some on Wall Street had expected. It's also, you know, good to take into account that as of Friday, the stock had already fallen, 15% this year. So maybe investors are like, all right, maybe that's enough. But, just looking ahead, executives have really, really emphasized the idea of McDonald's focusing on value and affordability. And really, they have almost termed this the summer of value, starting with a $5 meal deal. So it has started to, yield some results, but we have to see what it's going to do the rest of the year.
Yeah, and Daniela, you also had Peter Saleh, who's been following BTIG, who's been following this sector for decades. He really pointed out the international side that was weak and that was actually a surprise and that maybe that trend continues for the foreseeable future as well.
That seems to be the case. I mean, Chief Financial Officer Ian Borden on the call said that trends so far have also been negative in what we've seen in the third quarter so far. And he doesn't really expect the trends to continue. Something that he pointed out that was interesting is that in countries like France, the business there is very focused on families. And across Europe, they are actually seeing a pullback from that consumer group, from families. And so one of the things that they're going to do is launch a €4 Happy Meal, hopefully to bring back, the parents that are trying to treat their kids. But it's interesting because McDonald's actually implemented the value strategies in Europe earlier. They had something called the Max Smart menu that was available in countries like Germany, and they say that has worked out so far. So maybe that's a little bit of a signal that as they do that in the U.S. and as consumers start learning more about it, maybe the $5 meal deal here will also, help in the future. But TBD, really.
So McDonald's is out of the way. Let's push ahead to what else we're going to hear from this week. Starbucks in particular has had a super rough run of things. You take a look at just the share price, down about 21% so far in 2024. What are we expecting to hear from Starbucks? Because I have to imagine, again, with that sort of performance, maybe the bar is a little bit lower here?
Really, it is a very similar story. I will say that, since the beginning of this year, probably my whole job has become value. And even a company like Starbucks has had to focus on that. Maybe over the past quarter, you all saw something called the pairings menu that they launched, which is, a beverage and like say a croissant for $5. That it was almost unheard of, when it came to Starbucks. So it's a lot of the similar story. We do expect that their trends are also going to be pressured by these weakness in consumer sentiment, not just here, but also in places like China, which McDonald's also pointed out to today. So really, it went from last year a focus on we're doing well and we're going to build a bunch of stores to we'll see what sales trends do because people are cutting back on their lattes and their burgers.
Yep. Totally. That was a great, you're the value reporter, basically. Absolutely right. Well said. Daniela Sirtori of Bloomberg, thank you very much. So if you're kind of fighting the value war and then you're also trying to bring in more customers and you're all competing for a little share of the same wallet, what do? Some might turn to artificial intelligence to streamline the customer business. Working more and more with firms like Presto, franchise owners at Carl's Jr.'s, Hardee's Checkers, and Taco John's. Never heard of Taco John's. Jimmy John's, yeah, but Taco John's, I heard it's a thing. Utilizes Presto voice technology to streamline drive-through orders. So here in the studio to offer his perspective on the cost-saving side of AI at restaurants is Guy Lefevre, interim CEO of Presto. It makes sense, right? Like you're crushing on the top line. Everyone's kind of strapped. You want to help your gross margins, so you're going to look for efficiency. How does AI really help? Because all I hear is like, oh, it doesn't work for drive-through.
So it's interesting. It's actually both on the revenue and the cost side. So you say that you could be crushing your top line. The automation of upsell through Presto's technology is actually one of the main benefits. So humans are actually really inconsistent. If you ask a worker in a QSR chain to offer fries every time, they'll probably do it about half, whereas AI will do it every time. So you've got that side. And then on the cost side, what it enables you to do, specifically in those quieter times, with AI being able to take those orders, means it frees up those staff inside the restaurant to be doing other duties. So then you start to get really quite significant cost savings inside the restaurant as they're able to do other things, maybe even adjust the rota. Put those two things together and you get a really quite significant difference.
How does it solve for problems like accents in drive-thrus?
Yeah, so just over 6 weeks ago now, we actually launched our Spanish version in some of our Southern Californian sites to deal with the second language because that was an obvious barrier. And then effectively accents are everywhere on a spectrum between there. So we've got 2 core languages. Yeah, these models effectively learn over time. And so the more information that we put into them, the more they'll be able to handle new languages or accents, for an example. We actually don't see a huge amount of issue with the accent compared to other issues.
Well, I was going to ask, we were just talking about Tesla full self-driving, and full self-driving, you actually still have to have a person there overseeing it. I was wondering if it's something similar here where, okay, usually it's not a problem, but sometimes it is. Does a human still have to be listening and be available to step in? Sometimes.
So we use a mechanism called human in the loop, which means that nearly all of our orders lead with the AI beginning to take the order. But if the AI's confidence interval falls below a certain level, it effectively puts up a flag and says, I'm going to need some help with this one. Maybe the person said allergy, or maybe there was a difficult accent. What they would then do is bring in a human, so we have an offshore center that can then come and monitor the order and make any of those corrections. Over time, that will happen less and less, and this is very industry standard, not just in restaurants. This is basically all AI works like this. And that ensures that we have the highest level of accuracy, but also quite a lot of efficiency. As those AI models improve over time, you'll need less humans jumping in to make those corrections.
So one of the doom narratives around AI is that robots are basically going to take all of our jobs. And I mean, listening to this, it kind of makes me think of that. I mean, is it just the cold reality that this will get to the point where you don't need humans?
Yes, absolutely. And there are lots of locations where we don't use any humans at all. As I said, everything's on a spectrum. So we released the latest version of our technology called Pure AI about 10 weeks ago, and that doesn't have any of the humans in the loop. So you will eventually get to that point. However, I would say if you look at every industrial revolution that's ever happened globally, humans don't all get unemployed, like when we invented the cotton mill or anything. Humans move on to a different set of tasks. And I think that's what Presto is a very good example of. People aren't losing their jobs. What they're doing is they're moving on to other skills or other trades within the restaurant. So maybe they're spending more time at the front counter to improve customer service.
So what's the ROI for a customer at Presto?
So the ROI would be somewhere between, so some combination of the revenue upside, which we can see is anywhere between, say, 5 and 10% in a consistent store. And then when we look at the cost savings, that's a little more difficult. It's definitely not the case that it's add AI, take away human. It's not that simple because you're adding AI to reduce the cognitive load on the staff in the restaurant, freeing them up to do more things. We do absolutely have customers who are reducing the number of shifts they have, but it's not as simple as a kind of 1 + 1 = 2.
Because a lot of the concern, and this is obviously with the hyperscalers, is that you spend so much money, but then what you're actually able to charge to make up for that just doesn't match up yet. Is it super expensive for some of these restaurants to get that service from you guys?
Not at all. So we would be significantly cheaper than the wages of a single worker over a month in terms of our price point, and that's why a lot of our customers do have an excellent ROI. I would say, though, that restaurants is probably one of the few commercially scalable places where AI is actually being used currently. So there's lots of customers in other industries who are buying AI because they hear AI and they want some, and it actually doesn't work that well. Whereas in the restaurant industry, it's one of the few places where you buy that in and you do get immediate benefits.
Amazing stuff. Guy, thanks a lot. Really appreciate it. Guy Lefevre joining us, interim CEO of Presto. And that's sort of the concrete case where you can see maybe AI paying off. It feels like the question, though, for some of the hyperscalers this week, as this Bank of America was saying this, it's it went from a tell me story to a show me story. So how are you going to monetize it? The longer it takes, the longer you're stretching it out.
Exactly. And I mean, it is interesting to hear about actual applications. We talk about the picks and shovels all the time, but when it comes to actually where is AI being used, where can it be additive, like he was just telling us, the restaurant industry seems ripe for that kind of disruption.
Yeah. All right, well, coming up, we're going to talk about our top 3, where we focus on the top 3 movers and shakers at the center of the day's biggest stories. I'm going to reveal some of my inner nerddom.
All right.
Yeah, that's kind of next. This is The Close. I'm Bloomberg. Now for the top 3, where we name drop the people driving some of the day's most talked about stories. And this is kind of an insider Wall Street thing. But first up, Ellen Zentner, Morgan Stanley's chief U.S. economist, is leaving her post to lead a new global investment team within Morgan Stanley starting August 1st. She'll be head of the thematic unit. She'll be reporting to Lisa Shallett. We say this because Ellen Zentner is widely loved and followed by anyone in the markets, and it's just really interesting to see her moving on to a different post in the company.
Yeah, absolutely. And Shallett said in a memo that Zentner will focus on, quote, publishing thought leadership on major macro and economic themes, as well as working on advancing thematic research. So sounds like we'll still, of course, be speaking to Ellen Zentner a lot there. I want to move on and also talk about Ryan Reynolds, because the actor starring in Disney's Deadpool and Wolverine, which took in $211 million in U.S. and Canadian ticket sales this weekend. That is the biggest opening of the year. And Alex, I know that you contributed to that.
Oh, I did. Definitely saw it. I'm a huge Marvel fan. I'm a huge Deadpool fan.
Really?
I'm a huge nerd. So I definitely liked it. I laughed so hard, I cried.
Oh, my God.
With full disclosure, it wasn't as good as Deadpool 1 and 2.
Oh.
Fair enough. But I did really appreciate all the inside jokes and ribbing on Disney buying Fox and how they couldn't talk about cocaine. It was really funny.
Well, that's good to hear. I'm not a huge Marvel fan. I'm a huge Ryan Reynolds fan.
This does not surprise me.
And in any case, I will see it.
And you will see his face. Spoiler.
Good.
His good face, not like the Deadpool face.
The good face.
Right, the good face. All right, our third slot here. It's all about the Olympics. Simone Biles and Novak Djokovic, the Serbian tennis player, beating Rafael Nadal in the second round of the Summer Games. Meanwhile, the gymnastics star is set to compete in all 4 events during tomorrow's team finals, despite tweaking her calf during qualifying. If you want to know where I'll be tomorrow all afternoon, I will be at my desk watching Simone Biles and also prepping for the show.
Right, of course. And I'm not a huge gymnastics fan. I'm a huge track and field fan, so really excited for some of those events to really kick off. But I understand that this is kind of a comeback for Simone.
Huge. I mean, and also, if you watched her, like, her power was insane to the point where, like, she over-rotated the hardest skills on the planet because she had too much power going into it. And we have 20 medal counts right now, but only 3 are gold. And you can kind of hope that the women's gymnastics team will help move that gold number up.
I have to say, that's a problem I would like to have. Too much power, I just can't help but over-rotate. I'm just too powerful.
That's our Lord. Too much power, I over-rotate.
I haven't quite gotten there yet. But in any case, coming up, a busy week of central bank decisions ahead. We'll preview with Jennifer Lee of BMO Capital Markets. She joins us next to discuss. This is Bloomberg. Well, investors are looking ahead to a triple header of central bank rate decisions this week, with the Fed and the BOJ due on Wednesday, followed by the BOE on Thursday. Jennifer Lee, she is senior economist over at BMO Capital Markets, joins us right now. So we have 3 big central banks to pick from. Which of the banks are you most interested to hear from?
The one that is going to be a coin toss, first of all, thank you very much for having me on. And I'm going to say it's going to be the Bank of England. There is so much mixed opinion out there about what they're going to do, what they're not going to do. And this is even so within Bank of Montreal, the halls of BMO itself. So personally, I think that the Bank of England is going to stay on hold, and I think that might be a minority view, and I might be humiliated on Thursday with that call. But I just can't see how, I see the rationale behind, the reasons why they would cut, but I think there are reasons behind why they should not cut, and they should wait it out even further. And some of these reasons are being felt by other central banks around the world, and namely the services inflation that is still quite sticky.
So it sounds like what you're saying, Bank of England, very much a live meeting. It's going to be really fascinating to see what they do across the pond there. Let's talk about the Fed. Of course, that 2-day meeting kicking off tomorrow. And it was interesting. Last week, we actually had a column written by Bill Dudley saying that they should cut in July. Mohamed El-Erian coming out and saying something similar. But how much urgency do you think that the Fed is actually feeling to lower rates at this moment?
I think they're in a very comfortable spot right now because everything is sort of going in the direction that they want it to go in. Fed Chair Powell said just a couple of weeks ago that, with 3 encouraging CPI reports in a row, he's much more confident and comfortable, that inflation is heading in that right direction. But again, they want it to be, they need more than a few more reports before they can make that call. And of course, it doesn't look like such a bad thing to sort of be patient, just given some of the stronger economic data that we've seen of late. I mean, granted, we've seen a number of disappointing reports over the last couple of months, but the last 2 weeks have been definitely surprising on the upside. Shows that there is still a lot of resilience, a lot more oomph still in the U.S. economy. And, it doesn't hurt to just wait a little bit just to make sure that they're not going to make, a wrong decision by cutting too quickly. So for us, at BMO, we're still looking for 2 rate cuts in September and in December. But of course, like everything else is, we're all dependent on the data, and everything will be judged on a meeting-by-meeting basis.
Of course, we got a strong GDP print last week, so maybe it's silly to even ask, but when does the Fed start to worry about growth? When do they start to worry instead about growth instead of worrying about inflation, which has very much been the setup over the past 2-3 years?
So the Q2 GDP number, as you point out, was stronger than expected, but it's also a look in the rearview mirror. And some of the more recent data of late have been showing that we are still seeing that gentle, braking, gentle pressuring on the brakes. We've seen although we've seen some pretty good retail sales figures for both May and for June. The broader personal income and spending measures show that there has been some, again, slower consumer spending. We're seeing it in some of the earnings reports that have been rolling in over the last week or so. So we are starting to see that slowdown in the second half. And this is why the Fed, I think, is going to be comfortable that, that inflation is heading back down to that 2% rate. And they will start cutting rates. But I think, July is probably going to be a bit too soon. September seems to be a lot more, of a reasonable time frame.
Yeah, it seems like September is really when everyone has their sights set on. I want to talk about how the labor market factors into all of this, because we were speaking with Conor Sen of Bloomberg Opinion just a little while ago, and he was saying that if you parse through the earnings calls, it's become clear that companies across industries right now are basically banking on rate relief, that they're holding off on layoffs, waiting until the Fed cuts rates. And I'm wondering if that theory holds water with you, that basically if we don't get a Fed rate cut sometime soon, that we're going to start seeing the labor market materially weaken here.
That's a good point to make. And then plus the Fed has also started turning its attention toward the labor market, saying that if it weakens too quickly, then they will act, meaning that they will cut. But certainly the businesses, there's so much uncertainty right now. Waiting for the Fed, political scenario is also playing a lot of uncertainty in the markets as well. But at the same time, if the Fed does not cut, for example, let's just say they don't, it's, there has to be reasons why. Is it because inflation is turning back up again, or is it because we're starting to see a pickup again in U.S. economic growth, which would not be a bad thing per se, so that would suggest that there would be actually more demand for labor. So we'll have to see how this is all going to play out. But so far, everything seems to be coming along very nicely. I say that now, but again, strong growth in the first half, still showing resilient U.S. economy, but still slower labor demand, slower consumer spending. Businesses are going to start holding off a little bit more on their investment until probably after the elections to see what policies play out. And this is why we've got the economy slowing in the second half, and enough for inflation to start coming down and for the Fed to give them the green light to start cutting rates. I think they have more of a green light than other central banks around the world, actually.
Well, you bring up the election, and let's stay there, of course, because they're not making policy in a vacuum. There is the reality that the election is, I think, 99 days away. I do need to fact check that. But in any case, it's coming up quickly. Do you think it is a factor in their decision making about when to actually cut rates? And do you think it should be?
So they are supposed to be independent, right? So, in theory, they are going to be focusing only on the data. But of course, they don't operate in a vacuum. They are aware that there could be a lot of potential changes coming, depending on who takes the Oval Office and what kind of policies kick in. If we start seeing, for example, higher tariffs, that could also mean higher inflation. So this is something that they have to be very careful about with their policy stance. So I don't think that the Fed is going to be moving too quickly when it comes to rate cuts. It's going to be like a slow and steady pace. So I think July, again, this is why I could be wrong. That's happened before. But to see a July rate cut, I think would make me basically fall off my chair.
Well, you make a good point, of course, that maybe it's not the politics that they're paying attention to, the Fed, but they do have to pay attention to the policies that actually come about from what could be a new administration. Jennifer Lee of BMO Capital Markets, really appreciate your time today. Meanwhile, let's take a look at how markets closed on the day, the first trading day of a very busy week. You can see the S&P 500, it was pretty quiet, down, or rather up about 0.1%, but really tepid moves overall. You have big tech finishing a little bit higher, the NASDAQ 100 up about 0.2 today, but it had been up as much as 1%, so really gave back gains there. Speaking of giving back gains, take a look at the small cap index, the Russell 2000, finishing down about 1%. Meanwhile, a little bit of a rally in the bond market, 10-year yields falling about 2 basis points. This is The Close on Bloomberg. Well, Democrats and the Harris campaign are narrowing in on a running mate to counter Donald Trump and J.D. Vance. Let's get the latest on politics from Balance of Power co-host Kailey Leinz. So there's the question of who will it be and when will we know? Let's start with the who, because it sounds like we have a pretty good idea of who the pool is.
Yeah, Bloomberg has reported, Katie, that this short list has gotten even shorter and that the three candidates that Harris and her campaign are really considering are two that come from swing states, Governor Josh Shapiro, of course, of Pennsylvania, and Senator Mark Kelly of Arizona. Both of those picks, if they could bring their states along with them, would help Kamala Harris from at least an electoral college standpoint. The other, though, that Bloomberg is reporting is Tim Walz, the governor of Minnesota, which isn't necessarily considered a swing state, but it is a state that Donald Trump and his campaign have been suggesting they may be able to win alongside some other states, including Virginia, that have gone blue in the last several election cycles. So a move toward Governor Walz would be kind of an indication that Democrats really want to make sure that state is locked up and only compete in the known battlegrounds. Of course, this is a decision that she doesn't have too much time to make given the late nature of her candidacy overall. August 7th is the real deadline that the DNC has set for its virtual roll call, in which they will nominate the presidential nominee and vice presidential nominee before we actually get to the convention in Chicago. So really, we're talking the next week and change that Kamala Harris could be making this decision, Katie.
So, of course, the timeline really narrowing here. We should know sooner rather than later, and all eyes on that pick, because you think about what she's trying to do, what she's trying to add to the ticket by picking a VP, and it'll be interesting to see who she picks. Let's talk about J.D. Vance, though, because I think Kamala Harris over the weekend called him weird. Her words, not mine. It feels like J.D. Vance has received a lot of scrutiny over the past week.
Yeah, weird is something that has been continually coming up in Democratic circles. It seems to be some messaging that they're running with that certainly is doing well on social media, as well as we're faced with that kind of aspect around her campaign that we didn't necessarily have with Joe Biden, who, of course, is significantly older than her at 81 years old. When it comes to J.D. Vance, though, it's important to note that Donald Trump made this selection in tapping Vance as his VP before he knew that Joe Biden was going to drop out of the presidential race. So there's been a lot of talk in Republican circles about whether or not there may be some buyer's remorse when it comes to the senator from Ohio, who, of course, is very aligned with Donald Trump and much of its policy, including some of those populist leanings, but has had some stuff resurfacing within the last week, including an interview from several years ago with Tucker Carlson when he referred to childless cat ladies like Kamala Harris. He has faced a boatload of criticism over those comments, even though he says that Democrats are taking it out of context. So in part, the vice presidential selection that Vice President Harris makes will be thought about as to how they might be able to counter J.D. Vance. And I would just note as well that something that the Harris campaign has in terms of momentum is the money story. While there was a lot of talk about J.D. Vance potentially being someone who could bring in money from Silicon Valley, certainly you're seeing money flooding toward the Harris campaign, and not necessarily from those big donors, though that is happening too, but the small dollar donors. The campaign saying within a week they raised $200 million, and 66% of those donations were from people who were donating the first time this cycle, which indicates that there is a lot of energy behind her candidacy, as young as it may be.
All right, Kailey Leinz, really appreciate the time with you. That, of course, is Balance of Power co-host Kailey Leinz. And let's get more perspective on politics and delve deeper into what's at stake for markets and the economy. We have a great guest to do that, Bill Harris. He is the founder and CEO of Evergreen Money. He's also the author of The Investment Tax Guide, How to Slash Your Taxes. He's also the former CEO of Intuit and co-founding CEO of PayPal. And in addition to that, we should also note that Bill has donated to the Democratic Party in the past. So a lot that we could start with there. But let's start with, of course, that donation, those donations that you've made to the Democratic Party. Because as I understand it, you had donated to Biden in the 2020 campaign. You decided not to so far this cycle, and here we are. So before we look forward, let's talk about that decision. Why hadn't you donated to the Biden campaign?
Well, I think it's been clear for a year, and the voters have known this, that we have two candidates that are just too dang old. And every survey that we've done has shown that, in fact, what people say is the ideal age for a president is in their 50s. And in fact, people 18 to 29, they say in their 40s. You know, that's 25 years younger than either of the two candidates were. And so I was really concerned about this last summer. Again, just listening to the voters. And so I've done some tracking polls, some private tracking polls ever since, and have tracked this age issue. And it is very, very powerful. I'll tell you one thing. The most recent tracking poll we did, which was just before Biden stepped back, it showed Trump beating Biden in the battleground states by 5.4%. It showed a, quote, qualified Democrat younger than Biden beating Trump by 7.4 percentage points. I mean, that's an astounding gap. And, it's such a big gap that it's hard to take without a grain of salt. But even if it's half that, what it does show is there's a tremendous power to have the younger candidate in a race like this.
And of course, maybe the Biden campaign saw some of that polling as well, had their own polls which suggested the same, because here we are. So when we talk about the here and now, have you donated to Kamala Harris's campaign?
Not yet, but I anticipate that I will.
So what are you waiting for? I mean, why not now that we know that she's the presumptive nominee? Are you waiting for her to actually officially become the nominee?
I'm waiting to log into my bank account. It's only been 5 days.
That's true. Well, I do want to talk a little bit more about your past donations, because one of the criticisms of Kamala Harris becoming the presumptive nominee was that basically she was coronated, that it wasn't an open process, and you had led a small group of Democratic donors who had pledged $2 million to help fund basically a mini primary. I mean, how do you feel about this entire process? Well,
you're right. I was very much in favor of an open primary, a mini primary, town halls, the kinds of things that Ezra Klein or David Axelrod or James Carville, all of them were saying that this would be a great thing. And I think it would have been a great thing had we had more time. Mm-hmm. But given that the clock was running, I think the Democratic Party did exactly the right thing, which is to select someone who could pick up and run right now. After all, as was just said, 99 days left.
Yeah, it's pretty amazing how quickly this is coming up. And it's interesting, too. I mean, we saw this big rush of fundraising being funneled at the Harris campaign. And to me, that looked like money on the sidelines. Basically, yes. People coming out and saying, OK, I couldn't back Biden, but I can back Harris. And one of the questions is whether that momentum can be sustained. And listening to you, I mean, I wonder if you have any sense of some of the donor class that you speak to, whether they've already donated or whether they still plan to.
Well, I don't really speak to the donor class, and I'm not a billionaire or anything of that nature. But I think it will sustain. Clearly not at the current rate, but I think it will sustain. First of all, it's only 99 days. Secondly, there's a tremendous amount of pent-up enthusiasm, and predominantly, it's for Kamala Harris, but even more so, it's just looking for a way that Trump can be prevented from being in the White House once again.
And let's pivot here, because I also do want to talk about Evergreen Money. I read through your very impressive resume at the top of this interview. Tell us a little bit about Evergreen Money and what you actually do.
We try to give affluent households, the top 10% of the households, a way to maximize their money, increase the yield and decrease the taxes. And that's a very important thing. Nobody in the business thinks about taxes. And in fact, it is probably the single most important driver of investment performance.
Taxes, that is.
Taxes.
And so how do you actually do that? Because I report on ETFs, for example, and the
yes.
tax advantage of ETFs is one of the main selling points. So, I mean, how do you more broadly minimize taxes?
Sure. Well, let me just say that right now our first product out is a checking account. Mm-hmm. It's a brand new kind of a checking account. It's one where we sweep the money into Treasury bills and then make it available instantly when you need to pull it out or swipe a card. But by doing that, it's a checking account with 5.3% yield. And what that means, because it's in T-bills, goes to the taxes, it is exempt from state and local tax, which in California and New York City can be in excess of 13%. Mm-hmm. So that's the first product. But where we're really going, and this goes to the question that you were asking about ETFs. ETFs have swept the market. The majority of the new money coming in is going into ETFs. I think ETFs are great. Jack Bogle is one of my heroes. I worked with him for a while. But we can do better, because what we do or will do is take the ETF and then bust it up into its component parts. So rather than the S&P 500 in one big bucket, you will have 500 individual stocks. Now you can do tax loss harvesting, tax gain deferral, asset location, a whole series of things that I outlined in my book to decrease your taxes by 1 or 2 percentage points.
Well, that's fascinating. We should keep in touch. But unfortunately, I only have one question left with you. So let's talk about that 5% rate on T-bills, because I think that has been extraordinary for a lot of people. But when it comes to your business, does your business model change when the Fed does start to cut rates and you see that 5% yield go down?
I don't think fundamentally, because I don't anticipate a huge decrease. Perhaps it goes to 4.5 or something like that. But even so, if it's just 5%, do you know what that means? It means all the checking accounts in the world, in the country, if they were making 5%, that would be an additional $103 billion each year in consumers' pockets. And so, okay, it goes from 5% to 4.5. It's still a very big number.
All right, Bill, really enjoyed this conversation. Have to leave it there. That, of course, is Bill Harris. He is the founder and CEO of Evergreen Money. Now, still ahead, what investors need to watch for tomorrow? We'll preview it next. This is Bloomberg. All right, big tech obviously in focus this week with Microsoft earnings tomorrow, followed by Meta on Wednesday and Apple, and then Amazon and Intel on Thursday. Just an embarrassment of riches here. Let's talk about it all with Anurag Rana of Bloomberg Intelligence. And we have to talk about Microsoft. It's been a rough month. This share's down about 5% over the past month. Are you expecting Azure and that cloud growth to kind of save the day here?
Yeah, I think the cloud growth should be strong. I mean, I have no doubt that it's going to come out. AI is going to be strong too. But the big question is going to be whether investors are going to be happy with that. Because right now we are really running into a point where expectations may be getting ahead of the way AI buildup is happening. Right now we are in the CapEx phase. Over the next few years, we're going to see a lot more revenue coming in. And I think it's going to be really fun to see growth rates tomorrow for almost all the categories.
You know what's going to be super fun is the questions that they might get asked about the CrowdStrike debacle. I know it's not going to show up in the numbers that we're going to get tomorrow, but have to imagine it'll come up on the call.
Yeah, they do have to give some answers as to how policies and procedures were not followed and somebody else was able to drop a file and put a lot of the operating system at standstill. So, I think they will have to explain really what the procedures are and how they're going to prevent such things from happening in the future.
And just quickly, I know that we're talking a lot about Microsoft. We have a lot of other earnings to keep track of this week. Who are you most excited to hear from? Just in about 30 seconds.
I think Amazon Cloud is going to be the one big one because unlike Microsoft and OpenAI relationship, Amazon Web Services doesn't have such a close relationship with OpenAI. So whether they can showcase some AI workloads coming in or growth rate because of that, I think everybody would be looking for that.
All right, Anurag, really appreciate the preview. That, of course, is Anurag Rana of Bloomberg Intelligence. Let's look ahead to what else we're watching tomorrow. Before the market, we get some more earnings from PayPal and Procter & Gamble. After market, like we were saying, we have Microsoft, AMD, Starbucks. We also have some economic data in JOLTS and Conference Board consumer confidence. Also, the Fed's two-day meeting begins. Of course, we hear from Jerome Powell and everyone else on Wednesday. But that does it for us. Bloomberg's Balance of Power is up next. Have a great evening. This is Bloomberg.